Hello and welcome to The Resilient Investor. I'm David Stevenson.
Joining him is Samuel Ridley. Hello.
And on this programme, we're going to look at a veritable smorgasbord. Say that when you're drunk.
Yes.
Veritable smorgasbord of topics. You've got a question about...
What happens when interest rates go higher?
That's a very good question, for they might be. I'm going to talk a little bit about why I think chips, and that's not fish and chips, semiconductors are maybe at the right point in the cycle. And you've got a question about our friends from Asia.
Yes, e-commerce players replicating Amazon's success. So C in Southeast Asia, Mercado Libre in the Americas, and a little bit of Jumia in Africa. Are they plays
that are worth investing in? Okay, and then I'm going to talk just a bit about China as well, or as Trump would say, China. Okay, so I suppose the big question, what's the big question?
Interest rates going higher. What does that mean for the market? As I'm eternally glued to watching what the Fed does and Jerome Powell, and when he speaks, markets go up or down, and usually down. So interested to know the backdrop of that is interest rates going higher. What does it mean? So I can prepare, plan.
Yeah. So we talked a bit about this in the previous episode about what we call it macroeconomics, why you should care about it. And most of the time you shouldn't really care about it, just ignore it, it's noise. Mm-hmm. But interest rates going up, particularly, we've now had the fastest increasing interest rates pretty much for, I think, about 50 to 100 years. It's one of the most dramatic increases from basically next to nothing to, probably going to end up 5.5%, 6% in America. Mm-hmm. You can pretty much guarantee the UK will be behind that number, so probably 4.5%, 5%. You do need to care about rising interest rates. And there are probably, I'd say, three reasons. Number one, interest rates matter because of cash.
Yeah.
So if cash suddenly becomes more interesting, and we're seeing lots of instant savings accounts now paying 3.5%, and they'll probably be paying as much as 4.5% by the time it's finished. Then that's not a disastrous investment any longer. The long-term return from investing in shares is probably only on average about 7.5% to 8% a year. So if you're getting 4% a year, we're excluding inflation here, and I'll come back to that. That's not bad. So cash becomes more attractive, which I think makes investors more discerning. The second reason why you should care about interest rates is because quite a lot of investments are based on what's called a discount rate, and there's also built within this kind of discount rate, which is a financial model, there's a kind of assumption about what we call the risk-free rate is. And what that means is, if I put my money in an account where there's no risk, what return do I get? Which is the same as the first thing I said, interest rate. So if that risk-free rate goes up, then I would expect the rate of return on riskier stuff to go up. Yeah. I'm going to take a bigger risk, I want a bigger return. Now, the problem is whether or not those businesses can actually achieve that risk-free rate. Yeah. Can beat that risk-free rate as the risk-free rate goes up. So the valuation models all change. And so all things being equal, an increase in interest rates usually means that you have to have, you would want a lower PE ratio, a price to earnings ratio, for many of the businesses that you're interested in. Yeah. Because if you've got low interest rates, you can afford to take a gamble on growth, and you can say, I don't care if a PE ratio is 25 or 30 or 35. Yeah. If on the other hand it's 5.5%, that's interest rates, on average you expect to see a lower PE ratio. Yeah. So it does tend to force a kind of downgrading of the valuations that people put on shares. And then the third reason why it matters is because central banks don't shove interest rates up for no reason. They shove it up for a reason. Yeah. And that reason is inflation. And they would seriously be worried that there's inflation coming, or there is inflation, and it's going to stay high. And the general rule is that when inflation remains in the kind of 3 to 5% range, equities and shares do very well. Actually, it's a really good investment to do shares. But when inflation rates start going to staying above 6-7%, by and large, most financial assets, bonds and shares, do quite badly. Or they don't do as well. So a much more inflationary environment where interest rates have to be pushed up to 5.5% does take us into an uncomfortable zone. So it matters, basically. And my guess is that interest rates in America will probably peak at about 5.5%, maybe even 6%. and they'll probably peak at about 5% in the UK. And my guess would be that will probably force us into, at minimum, a slowdown, if not a recession. And that's probably bad in the short term for corporate profits. Does that answer your question?
It does indeed.
So you're more worried now or less worried?
I think there's more pain to come.
Yeah.
But I see pain as a buying opportunity.
Yeah.
The optimistic investor.
No, absolutely. Yeah.
So,
volatility, which is pain, is usually, it should not be seen as always a risk and should often be seen as an opportunity.
Yeah. No, I think particularly reminding everyone that, I'm in it for the long haul. That's the next 15 to 20 to 25 years.
Yeah.
There's an opportunity to buy some great businesses at the moment at a cheaper valuation. However, there are businesses I have a feeling that will go bust over the next 12 months, and probably be a shedding exercise where there'll be quite a few businesses in the growth corner that I've heavily invested in. And that's one of the things that in my own time at the moment is trying to weed out which of my growth stocks are worth hanging on to and which are the ones that I just don't see a way forward. And that's really challenging for me.
I think
I don't have experience with this stuff with previous, so
I think a couple of simple guide rules really, or guide rails. One, invest in growth businesses that are actually making a profit. Mm-hmm. Because if they haven't been making a profit in the last year or two, and if we do have a recession, I'm sure as hell we're not going to make a profit in a recession. Yeah. Right. So try and invest in profitable businesses. Yeah. Two, try to avoid businesses that basically need to raise capital really quite quickly in the next 6 to 12 months. So they're loss making.
So that's low free cash FCF. If they don't.
No, actually, no. Even more brutally than that. Let's just say you've got a new business IPO, and look, they're growing like a weed, but they're going to need to raise more money in 6, 12 months' time. Mm-hmm. There's a pretty good chance they won't raise any money, and that could be curtains to that business. Yeah. Yeah. Another interesting guide rule is try and go after businesses where they've got pricing power and it's not enormously competitive. Yeah. So they've got something unique.
Ability to build a moat out around themselves.
Absolutely. Good profit margins. Yeah. So that so you can put up with businesses that have got ridiculous valuations if they've got all those things. So a classic example is we're going to come on to it in a minute. I own shares in Nvidia, which is a company that does GPUs, graphic processing units. Now their shares are valued at, I personally think, frankly, ludicrous levels. Yeah. But it's a fantastic business. Yeah. Yeah, because basically, if you want to build an AI computer, you're going to probably have NVIDIA GPUs in it. Yeah. It makes money. It makes cash flow. Yeah. It's got very high operating margins. It's got a wide moat that is very difficult to break into. Mm. So I could just about, even I'm uncomfortable, live with its ridiculous valuations because I can see why I own it. Yeah. But those are some of the guide rails. And I think if you're in a business that is not generating positive cash flow, is not generating a profit, is basically needs capital. Low sales growth. Yeah. They're probably not longer for this world.
Yeah. Mini checklist there.
Absolutely. So I talked about Nvidia, and that brings me nicely to chips, semiconductors. And I think there's a fairly decent chance that we may be approaching, we're not there, but the next up cycle in the kind of semiconductor cycle. The semiconductor industry, like lots of markets, goes in cycles. Yep. We have bull markets and bear markets in the stock market. We have recessions and booms in the economy. The semiconductor market has the same thing. It has its up cycles and its down cycles. And it's been going through a down cycle because basically all sorts of reasons. It ran into trouble. Supply chain issues. Absolutely. Supply chain issues. There's always this worry about Taiwan and China and all that kind of stuff. And there's loads and loads of reasons why it's on the down cycle. But when the up cycle comes, the benefits from investing, even if you can't catch the bottom, are quite often huge. Shares can quite often double in value. And in fact, Nvidia is probably a good example. Yeah. It's early in the cycle. It makes a particular type of chip that's done well. It's already up 60% this year. It's amazing.
Good stuff.
Now, that could extend out beyond Nvidia. And I think it's quite an interesting time to be looking at the semiconductor industry because although bits of it are in trouble, like in memory chips, Samsung's pretty big in them. I think they're pretty commoditized and cheap, and they're not going to make any money out of them. But the more complicated chips which are effectively logic circuit chips, or chips that sit inside AI computers and servers, or anything in this kind of industry, even 5G and the Internet of Things. One of the things people don't realise that people think 5G is about 5G on your phone. Well, it is about that, but really what it's actually about is about having loads and loads of devices called the Internet of the Things, which are connected everywhere. Yeah. So you could have, for instance, your fridge might have a connection to the internet. Now people laugh at that. What's actually more realistic is a factory, an enormous factory, could have 5G chipsets all around the factory, so that the entire factory is effectively enabled and networked. And those kind of, the Internet of Things is really important. That 5G technology works, and those 5G chipsets are really important. So the cycle, I think within the next 12 to 18 months could turn. And when it turns, it tends to turn quite violently.
And also, you mentioned the 5G of everything and factories and chips. Running these factories, creating these factories, is hugely expensive, isn't it?
Yeah, and that's the wide moat. And we go back to that
yeah.
wide moat point, really, which is there's only a limited number of, there's actually only really two companies that can afford to build the massive
super plants.
Yeah, fabricated plants, fabs they're called them, and that's
Oh, actually, very good ice cream, a fab.
Yeah, one of my one of the favourite ice cream. So but not that fab, and that doesn't cost $20 billion to build.
No.
Whereas that's what Taiwan Semiconductors, and Samsung, who are the main operators, not the exclusive, but the main operators of fabs. Intel's obviously got them as well. They cost $10-20 billion to build. I mean, they're huge
money.
and the capex is massive. And then, so you've got a kind of a divide between the people who can operate the fabs, which in reality boils down to, TSMC, Samsung and Intel, and then you've got the guys who do the design, So effectively, they don't have their own fabs, but they do incredible designs. That's Qualcomm in, for instance, in telecoms, the telecom sector. Nvidia basically in GPUs, and lots of these different companies in the semiconductor industry, and it's a whole ecosystem as well. That's what people forget. They always look at the big names, but actually, there's a lot of companies like Broadcom on semiconductor, and then there's ASML, which is a big Dutch company that makes equipment that goes into the fabs. It's a huge ecosystem, actually a massive ecosystem, and if you invest in a fund, you'll quite often invest in the whole ecosystem.
Yeah. I mean, ETFs are great for that.
Yeah, and in fact, I think you have to. Yeah, I think, correct me if I'm wrong, I don't think there are any actively managed funds that invest in semiconductors. If there are, I don't know of any.
No.
And in fact, there are about 3 or 4 in the UK you can invest in ETFs.
Yeah.
The one that I personally prefer is probably the most established. It's certainly got the biggest in AUM. Is from VanEck. VanEck have got a semiconductor chip ETF. The main index that you can invest in is called the Philadelphia Index, which actually I think it's run by NASDAQ, which goes under the ticker SOX. So if you're in America, you could buy loads of ETFs that track that. SOX, yeah. That you could track that SOX index. In the UK, the biggest one is from VanEck. It doesn't track SOX. It actually tracks a kind of custom build version of the semiconductor index.
Right.
But that's probably the best way to find ETF. Leads me nicely to, what do you use chipsets for? You use them in phones and computers, but what do you use the computers and phones for?
E-commerce as a broad term, but banking, finance, shopping, gaming, you name it, the super app.
Yeah.
And obviously Amazon over the last 20 years has done a fantastic job of growing its business. Focusing globally. 2 years ago, probably just in the middle of COVID time, it started to dawn on me that there are other e-commerce providers around the world who are doing mini Amazon ventures in their respective regions, and actually predominantly emerging markets, as I would call them.
Yeah.
So Southeast Asia, we have C, ticker SE.
And that's SEA?
SEA is a business. Who are effectively a super brand that has apps for banking, gaming, shopping, you name it, they're trying.
Do transport as well, don't they? Don't they taxis? I think they possibly, yeah, I'm not too sure, but yeah.
It wouldn't surprise me.
Because they all want to be super apps, don't they?
They all want to be super apps, and they're working on regions the same as Mercado Libre in South America.
Yeah.
These are regions that still have huge percentages of population not using banking, e-commerce, shopping. So
they've all got mobile phones.
But growingly all have mobile phones. So there is a bridge gap to be made there, that when the banking percentage of that population increases and the ability to shop online, it surely spells good things for these e-commerce providers. That's at least why I'm investing in C and looking to move into a Mercado Libre position. And I have Amazon since they did their stock split.
Because they won in Africa?
Jumia, at least I'm least knowledgeable on that market. Again, it spiked up during COVID as a stock to watch on many of my watch list notifications. It has gone a bit quiet, bit of a riskier move, whereas seeing Mercado Libre are slightly, I think, more established, if I'm not wrong.
And I suppose you're missing out the Chinese ones because there's some massive Chinese super apps as well, but they're always more problematic, aren't they?
Yeah, and China, I mean, when we talk about China as a market, I, as an investor and a novice investor, have always been spooked a bit by the China market because of its ups and downs and its government influence. And it's a tough market for a novice investor to really have a hold on. And I'm not saying that South America and Southeast Asia is any better, but it seems to be less external factors causing ups and downs, and more
less geopolitical. And the big super app, I suppose, apart from Tencent, Alibaba, and Alibaba's got Ant Financial, which is their kind of version of the kind of banking system. Tencent have got their own. Is an outfit called, I never know how to pronounce it, called Mutan or Mutang, which started off as a kind of delivery app.
Not Coupang?
Yeah, and them as well. They started off as delivery app, but they've now moved into super app territory.
So it's looking at these super apps. It's taking a geographical play, but also a sector play. So some verticals and horizontals there. Trying to get clever. From my perspective, it's having one in each region. So I'm almost hedging my bets. Hopefully they all do well and end up like a mini Amazon. But if they don't, and one underperforms and one, because it's interesting. C is trying to play into South America. Mercado Libre has plays into Southeast Asia, so they are looking at each other's markets, but that's a costly exercise for them. So it's very interesting. I'd look out for it if you're not already. What's your view on it, David?
Yeah. I mean, very interesting. Of course, you always have to remember that Amazon, though, as a share, has done phenomenally well. Well, until recently. It isn't massively profitable.
It invests a lot of its own to keep.
To be fair to it, if it didn't invest so much, it probably would be profitable. But it's not been massively profitable in terms of earnings, cash flow to the investor. So that always, I put a little kind of question mark there. I absolutely get why you're interested in them. They all basically, I imagine, got pulverized after the kind of initial COVID enthusiasm. So they all got good kicking. I know Mercado Libre, which I have owned in the past. Was up in over the thousands and certainly.
So I think it reached $2,000 mark, came stumbling back down to about $600.
That's right. Yeah.
Now it's at about $1,200. So it was a good opportunity to bounce back. C, I've held on to right to the bottom, and we're now down to $60 or $70 mark. We had a good day yesterday on earnings report, 20% rise, but of course, 20% on a 90% position down.
It's not.
You've got a long way to go.
So I think that the problem, I suppose, the problem is that they're all kind of growth businesses.
Yes. Yeah.
And therefore, there's two factors in there. A, the valuation you put on the growth, and B, what is the growth going to translate through into profits, So I've already flagged that Amazon itself has, has got a interesting history about transforming its phenomenal sales growth into bottom line profits. It has chosen to invest. So that's always a concern, and I suppose the concern is, can they grow fast enough to keep up with the valuation, which is the other factor? Because these stocks, Amazon, if one came up with what one would think is a sensible kind of earnings stream for Amazon, it's still, compared to its share price and its market cap, it's quite expensive stock, and when it's been producing profits, it hasn't been producing profits recently. It's been multiples of 50, 60 times earnings, and most of these stocks, I've owned Mercado Libre in the past, are valued very highly, in the, definitely not 10, 20 times profits, times earnings, but in the many, 50, 60, 70, 80, 100, depending on where you are in the market. And I suppose you have to ask yourself, does the valuation that you get on those stocks, is that equivalent to what you think the growth rate of both their sales, because you do want, obviously, vastly increasing sales and turnover, but also profits. For it is no use, basically, bumping up sales, if you can't ever produce a profit,
And something that these brands have in common, the emerging players, I find, is, like I mentioned with C, you've got a shopping app, you've got a gaming, you've got banking, You'll find that one of these corridors will do very well, and they'll put all their money into the wrong corridor. So they'll pump money into the product that's making a loss to support the product that's making a gain. And that's where they burn cash. And then you'll find midway through the year, they'll decide to lose one of their apps because it's not making any money and burning cash. But then to investors, that's a bit of a nervous move that are they shrinking?
Yeah.
And so that it's an incredible, the ecosystem, you have to go quite deep into it, I find anyway.
And even the success, Amazon arguably, I got episode 2 of the Lord of the Rings TV series,
yes.
whatever it's called.
Yeah.
Amazon has pumped billions.
That's the most expensive TV show in history thus far.
Billions into that Prime Video. And, I understand why they're doing it. Yeah. I'm not convinced that it's a brilliant idea. So, and Amazon, I would say, has probably got a brilliant track record at actually being judicious about what it invests in.
AWS has done
fantastic business. Yeah. So if I'm going to trust anyone's judgment on big capital decisions and market decisions, I trust Amazon, but even they make mistakes, and by the way, expensive mistakes. So that's a concern. Although, but the flip side of it to sort of finish off on is, if investors need to go where the growth is.
Yes.
And the growth is in developing or emerging markets. Yeah. And that's where the demographic bonanza is happening. It's in places like Indonesia, Malaysia, Brazil, Africa, where there's still a young or younger population, lots of people entering working age group, huge increase in employment, huge growth of the middle class.
Rise of social media, making everyone connected online.
Yeah, absolutely. And everybody on mobiles, if not 2 mobiles. So, Warren Buffett used to say you fish where the fish are. If you're an investor, you need to fish where the growth is going to be. And it is quite clear the growth is going to be in those markets. I think the ultimate question is whether or not the valuation is right and whether or not they're capable of producing the profits. And finishing off on that, I suppose the ultimate example of that is China. Would you invest in China?
Would I? I mentioned earlier, I'd love to. It just scares me slightly. There's a lot of factors at play that seem to turn the China market up and down and left and right.
More left than
right. I don't have a lot of experience with that. So it's finding the right time to enter and to what part of the market, really. So I'm not in it at the moment, but I would heed advice.
So you could, so one way into it, there's a company called Prosus. Yeah, Prosus.
Okay.
And it's Dutch listed, but I believe it's quite easy to buy on most platforms. Yeah.
Okay.
And it's owned by a massive South African company called Naspers. And Naspers is a massive media company in South Africa who, for lots of interesting reasons, took a stake many, many years ago in a small little Chinese company called Tencent. And now are sitting on a huge stake worth tens of billions. And it sort of overshadowed the South African media business. And then they basically spun off the Tencent shares into this business called Prosus. And Prosus has been slowly selling down the Tencent shares and investing in exactly the kind of businesses you just talked about.
Yeah.
Big Indian businesses. They've been investing in lots of e-commerce businesses all around the world, in developing markets and in developed markets. And so they've built effectively their
ecosystem.
Exactly that. They're ecosystem investors. And they've effectively got 2 bits of the business. They've got this big portfolio of what is effectively a venture capital portfolio, which is effectively valued at zip. Yeah. And then they've got these huge amount of shares in Tencent, which are valued at a massive discount. Yeah. Because Tencent's cheap and their shares in Tencent are cheap. Yeah. So effectively, Prosus is a highly geared play on Tencent on China, but you also get the rest of the portfolio. And
interesting.
I've been looking, and Prosus's shares do go up and down with Tencent's share price. Yeah. So if you're looking for what I think is a manageable way to invest in one of China's preeminent businesses, Tencent, and also pick up a really interesting portfolio of other e-commerce and e-payments and fintech brands, then Prosus is a way in. Very volatile share price.
I'm used to volatility.
Yeah, exactly. Especially with the C shares. But it's actually not that bad. I think from memory, it's quoted in euros. It's ranged between about 40 and 80 euros. So it's not bonkers.
No. Okay.
But that's as far as I would go. Yeah. Okay. I personally wouldn't buy pretty much anything else to do with China, because I think for all the reasons that you've just said, I think it's just too problematic. Yeah.
Would you say it's too political?
Yes. Yeah, absolutely. Yes. I think it can be cheap sometimes. So after saying there's only one way and there's actually a second way, and you could look at something as an investment trust for Fidelity called Fidelity China Special Situations or Special Situations China. Okay. Very good manager. invest in smaller cap companies, so less under the control of the party.
Yeah.
I think very well managed funds. I think if you're going to play the kind of China thing, that's another way of doing it. Okay. So yes, politics is a massive bit of it, but the other thing which I think people also underestimate is that Chinese shares can quite often spend many years being cheap. I think I saw some statistic which is something like Chinese equities go through long spells, 70% of their time, where they're basically a bargain. Yeah. And then they have a short period of time where everybody gets terribly excited about China and the prices spike. So China can be increasingly a bit like Japan, where, many Japanese sectors and companies are ridiculously cheap, but they don't go anywhere because they don't really have a political problem, not so much. But they've got governance problems. No one really believes that the management care about foreign shareholders and all sorts of issues. Actually, the Japanese are getting a lot better at that. But they don't go anywhere for a long period of time. So there's a double risk with China, which is the obvious politics, the obvious Taiwan issue. But then there's the kind of less obvious that actually Chinese shares can stay in a funk for longer than you can stay solvent.
Requiring the patient investor. But actually there was... When I mentioned volatility, sometimes I do feel like the volatile investor
needs to be resilient.
Of course, honing it back. One last question, left field. The VIX. Briefly explain the VIX.
Yeah,
because I've heard it on various
it's very
talk shows, and
it's very simple.
Some people invest.
Oh, you can definitely invest. I think you'd be a bit mad to invest unless you're a day trader. Yeah. So the VIX, it measures the ups and downs, the turbulence, the volatility of the S&P 500.
Okay.
It's actually the VIX itself is actually a series of futures contracts that are written on the likely value of the S&P. Well, actually, sorry, let me back up. So there's the S&P. Where do what's the volatility S&P?
Yeah.
And then that volatility will be expressed in the VIX.
Yeah.
And then the VIX index itself is built upon a series of futures contracts, which will be about the volatility of the S&P 500. So if you think the S&P 500 is going to be very volatile, which usually means downwards volatile, then you'll be long the VIX, and you'll be short the S&P 500.
Yes.
So the VIX itself is basically an index of futures which track the volatility of the S&P 500.
Right.
You can invest in VIX via futures, and I think you can invest in it via ETNs.
I believe,
or which are exchange traded notes.
Interesting.
Obviously, the thing to say about the VIX is
warning.
It's volatile. Actually, oddly not as volatile as people think it is. So remember I said about China, you go for long spells where it's sort of range bound, it doesn't go anywhere. Actually, the VIX is quite similar. It goes for long periods of time where markets are fairly stable, and then it will have a sudden complete lunatic phase. And volatility will just go bonkers. And the problem is trying to work out when that lunatic phase happens is a bit like trying to read the runes. I've got no idea. It tends to be quite closely aligned to interest rates, bringing us full circle. So if you think the recession's about to happen, markets become more volatile, S&P 500 starts falling, volatility goes up, your futures, if you're long futures, they go up. But predicting that, terrifically tough. And the only thing I'd say is VIX is useful to look at. I personally would never invest in it.
Use it as a gauge, not a tool.
Useful thing to look at. Called a fear gauge, they called it. In fact, Robert Harris, the novelist, did a book about it, which is turning
the fear index.
The fear index.
Very good. That.
Which is a Swiss-based hedge fund trader, wasn't he?
Yes.
So it's interesting to look at. And the last thing I'd finish on is don't treat volatility, and we've said it already, as a risk. Treat it as an opportunity.
Yes.
Quite often investors behave like a herd. They panic like a herd. And then they just go bonkers and they just sell everything, good and bad. And quite often during those volatility episodes, really interesting stocks get sold off like crazy. Just basically because quite often people just they've got trading positions, they have to sell out. So they just sell everything, because they've gone over their risk quota. So look on high volatility occasions as an opportunity, but be careful because those high volatility occasions, they can last for longer than you think they can. There's lots of studies being done which show that actually a period of high volatility can last for as many as weeks and months. So people think, the VIX has suddenly doubled, therefore it's going to calm down again. Well, no, actually the VIX can then double again, and then double again, But by and large, most big episodes of volatility only really last probably for at most a couple of months.
Very good, David. Thank you for the answer on that.
Right, stay tuned. We'll be back in a few weeks' time. Hope you've enjoyed The Resilient Investor.